Well, here's a question for you. What individual is the most powerful economic actor in the world? Well, the United States has the largest economy of any country in the world, so you might think maybe the President of the United States. But, the President of the United States has a lot of control over foreign policy in a very direct sense, but all tax and spending bills have to go through Congress before the President makes a choice about signing them. Maybe it's someone like the leader of Saudi Arabia for the amount of impact that person can have over world oil prices, or maybe it's someone in China with that rapidly growing economy. But even in those non-democratic countries, individual leaders are often constrained in various ways by the different groups to which they belong and owe allegiance. Well, in the United States, Article 1, Section 8 of the U.S. Constitution gives Congress the power to coin money and to regulate the value thereof. In 1913, Congress created the Federal Reserve Bank and delegated these powers to the Fed. The chairman of the Federal Reserve has great power over the money supply and interest rates. And on a day-to-day basis, a year-to-year basis, that power is not directly limited by Congress or by the President. In some ways, you can make a case that the head of the Federal Reserve, the head of the Central Bank of the United States, is the most powerful economic actor in the world. The previous lecture focused on the concept of money and how money was interrelated with the nation's banking system. In this lecture, we want to focus on what is a central bank, like the Federal Reserve Bank in the United States, and what powers does it have. Then the next lecture will be, how does a central bank choose which policies to follow, and why do we give such powers to a central bank rather than to elected officials? The Federal Reserve, like most central banks, is run with a mix of public and private elements. In the jargon, we call it a quasi-public corporation. Quasi-public meaning it's a private corporation technically, but it has some very strong public elements. Officially, the Federal Reserve Bank is a corporation which is owned by all of the federally chartered banks. So while it's officially a company, in that sense, officially a private company, it's not a company you can buy stock in. It's not listed on the Fortune 500, and you can't invest your pension in the Federal Reserve. The Federal Reserve is a peculiar organization because of the way it mixes government appointees with representation and ownership, ultimately, of private sector banks. At the national level, the Federal Reserve is run by what's called a Board of Governors. The Board of Governors consists of 7 members. Each member is appointed by the President and then has to go through confirmation by the U.S. Senate. These boards of governors' terms are structured in such a way to try and create some political independence. The board of governor appointments are for 14-year terms, which means once you're appointed, you would outlast the president who appointed you. And the terms are arranged so that one term expires on January 31st of every even-numbered year. So over 14 years, the entire board would rotate. A person can serve only one full term on the Board of Governors. However, these 14-year terms are so long that board members often leave before their term is completed. And if a person is appointed to fill out the remainder of someone else's term, then that person could still be appointed to a full 14-year term of their own. One member of the Board of Governors of the Federal Reserve is designated as the chairman. And from 1987 up through 2006, the Federal Reserve Chairman has been Alan Greenspan. Greenspan was originally appointed in 1987 to fill out someone else's term, but then he was appointed to his own 14-year term in 1992, and that's why his term lasts through 2006. Again, the point of this structure is to ensure some degree of political independence. Yes, you have to be appointed by the President and confirmed by the Senate, but once you're in the Federal Reserve System, once you're a governor of the Federal Reserve, then on a day-to-day basis, you're quite insulated from day-to-day politics. Now, how does the Federal Reserve, or how does a central bank in general, enact its monetary policy? In other words, monetary policy, as we talked about, is the policy of expanding or contracting the money supply, of encouraging or discouraging a greater amount of aggregate demand or a lesser amount of aggregate demand in the economy. Well, a central bank has three main tools for working with the web of banking and money to expand or contract how much money is out there. And the three main tools are reserve requirements, the discount rate, and open market operations. So let's walk through these three main tools one by one. The first tool, the reserve requirement. The reserve requirement is a requirement that banks are not allowed to loan out a certain percentage of their deposits. Now, what does that mean exactly? Remember that banks get deposits, they lend out the deposits to other banks. Those banks, they lend out the deposits to people. People deposit the money in other banks. The banks then have those deposits and they can lend out, and this web of depositing and lending keeps going on and on. Now, every bank is required to keep some of its deposits on reserve at the central bank. And what on reserve at the central bank means is, in effect, they have to deposit that money with the central bank. There's no payment of interest in exchange for that reserve requirement. It's just money that they have to hold aside, kind of as a safety reserve. Now, if this reserve requirement gets higher, then each individual bank has less money to lend out. If each individual bank has less money to lend out, and then the quantity of loans available in the economy diminishes, one would expect that interest rates will rise. The price of borrowing money would get somewhat higher. On the other side, if the reserve requirement is reduced, then all the banks in the economy can hold less money with the Federal Reserve. Banks have more money to lend out. They can expand the supply of lending and aggregate demand in the economy. And as more funds become available to lend out and the supply of loanable funds expands, then the interest rate should decline a little bit. In 2003, just to give you a sense of how this works, the Federal Reserve required that banks hold reserves equal to 3% of the first $41.3 million deposited in checking and savings accounts for the bank as a whole. And for any amounts deposited above $41.3 million, the bank had to hold reserves equal to 10% of that amount. So that was the reserve requirement in 2003. Now, almost every year, small changes are made in the reserve requirement. For example, that $41.3 million dividing line is sometimes bumped up by a few $1 million or bumped down by a few $1 million. And of course, banks are always inventing these new kinds of accounts. And so the question of whether something is in a savings account or a checking account, or exactly how these different accounts work, requires some different technical rulings. But changes in reserve requirements that have a large effect on bank reserves are actually quite rare. This tool of monetary policy, at least in the United States, is not used all that often. Second way in which a Fed could think about controlling and encouraging banks to lend or not lend out money. Let's imagine a situation where the bank has loaned out most or perhaps all of the funds it can possibly loan out, right up to the edge of the reserve requirement. And of course, banks can't be sure at the very end of the day, if they're right on the edge, have they gone a little too far in lending, not quite far enough? Or what if someone comes and gets deposits and pulls some money out? Then unexpectedly, they might find that they don't quite have enough deposited with the central bank to meet the reserve requirement. Now, in that situation, the reserve requirement has to be met. So what the bank does in the short term, if they get into the situation where they're right on the edge, is they borrow from the central bank. They borrow short term, just for long enough to get their accounts straightened out, to adjust their balance of loans and deposits so they've got enough money stored for the reserve requirement. When that happens, when you borrow from the central bank, then the interest rate that is charged to an individual bank for borrowing from the central bank is called the discount rate. So just to be clear on the definition there, the discount rate is the interest rate charged by the central bank on loans that it makes to individual banks. And that discount rate is the second big tool of monetary policy. Let's think for a moment about how the discount rate would work. Imagine that the central bank raises the discount rate. It charges a higher discount rate to individual banks. When the central bank does that, it's going to encourage banks to keep money on hand, because they know that if they run over and they do need to borrow from the central bank, they need to pay a high interest rate. And so banks will be encouraged to leave a sort of an extra margin, not just the reserve requirement, but some extra margin to make sure they don't bump into that reserve requirement. And that extra margin means banks would loan out a little bit less than they otherwise would. So a higher discount rate from the central bank discourages banks from loaning a little bit, will reduce the amount of money that's out there in the economy. Conversely, what if the central bank reduces the discount rate? Well, if it reduces the discount rate, then banks are going to be less concerned that they don't have enough on reserve at the central bank. And if they're less concerned that they don't have enough, then they're going to be more willing to lend right up to the maximum possible, because they know that if they need to borrow money from the central bank, it's not a big deal. It's not going to be a high rate of interest that they need to pay. And these are extremely short-term loans. Often they're literally overnight. So a low rate of interest overnight isn't going to be a big deal. Now, in practice, although this is a perfectly good theoretical tool of monetary policy, the Federal Reserve most of the time lends relatively little money at the discount rate. Before a bank borrows from the Federal Reserve to fill out its needed reserves, the bank is expected to first try and borrow from other available sources, like other banks. So this discount rate, which is the rate charged from the central bank to individual member banks, doesn't have as much of an effect as you might think, because not very much is borrowed at that rate. Instead, the key interest rate is probably the rate at which banks charge each other for these overnight loans. And we'll get to that interest rate in a moment. So ultimately, the discount rate doesn't get moved up and down a whole lot. It does in some cases, but it's not a very commonly used tool of monetary policy. So, third tool. I've just given you two tools and said neither was used very much, and you can intuit that the third tool is really the main tool of monetary policy. The third tool is referred to as open market operations. And open market operations occur when a central bank buys or sells bonds with the goal of decreasing or increasing the money supply. Now let's think about how this works. Banks, remember, are holding assets. They've got these deposits that people have given them, and they need to invest those deposits one way and another. Some of the deposits, banks in effect loan out to people, and they get interest rates in that way. But most banks also hold a certain amount of money in bonds, usually in government bonds, and they receive some interest just from holding those bonds. So, the Federal Reserve can buy and sell bonds with banks. Let's say, first of all, the Federal Reserve goes to banks and buys bonds, and particularly here we're talking about bonds issued by the U.S. government. So the Federal Reserve goes to the banks. The Federal Reserve gives the banks money. The banks give bonds to the Federal Reserve. In that situation, the banks now have more money to lend, while the Federal Reserve is holding the bonds. So when the Fed buys bonds from the banks end up with more money to lend out. Remember, bonds are not money. They're not part of M1 or M2 or M3. A bank which is holding bonds, which has invested depositors' money in treasury bonds, can't lend out the bonds. That money is in effect tied up. And so when the Federal Reserve buys the bonds, it loosens up that money, it provides money to the bank, and then the bank can lend out more than it otherwise would. What's the intuition on the other side? What if the Federal Reserve takes some of the treasury bonds that it's built up over time, and it sells those bonds to banks? Then the banks have more bonds, and the Federal Reserve has more money. The banks have handed over money in the sense of M1 or M2 or M3 to the Federal Reserve, and now the assets of the bank are tied up in these bonds which they can't lend out. So when that happens, then the bank is going to have less money to lend out. The quantity of loans in the economy will be smaller, and aggregate demand will be diminished as well. open market operations are the most primary and direct and commonly used tool of monetary policy. The real reason for that is that the reserve requirement and the discount rate require sort of thinking about how will banks react to a change in rules, and how will banks react and think about what they're going to do if this interest rate goes up or this reserve requirement goes up. That's a bit of a sketchy thing to try and think about. One can never be entirely sure. But with an open market operation, you can order a specific quantity of bonds to be bought or sold. You can see the result, and if you want to do more, you can do more. So it's a fairly direct and predictable, it's a lever that really seems to work. The open market decisions about buying and selling bonds are made by something called the Federal Open Market Committee, the FOMC. And the Fed Open Market Committee actually is made up of 12 members rather than just the 7 on the Board of Governors. It includes the 7 people on the Board of Governors, but it also includes 5 representatives from bank districts all around the country. And that group sort of rotates over time. So decisions about open market operations are not just made by these presidential appointees, although they do have a majority of the group of 12 on the Fed Open Market Committee. There also is input from people who are actually involved in banking all around the country. Remember from the discussion of banks and money in the previous chapter that banks create money through this web of interconnected loans. One bank makes a loan, it's deposited in another bank, it provides the basis for an additional loan, and so on. Essentially, these tools of monetary policy all work because they make banks either more or less eager to lend, or, to put it a little differently, more or less able to lend. Now, to nail down this point, let's talk about how monetary policy directly influences lending, aggregate demand, and interest rates. If you want money supply to be larger, what can you do? Well, you could either have a lower reserve requirement. The lower reserve requirement means banks are willing to lend out more. A lower discount rate means banks are willing to lend out more. Or you can have an open market operation of buying bonds from the banks. So the banks would have more money and fewer bonds. All these steps to expand the money supply can be referred to as expansionary policy, a term we use for fiscal policy, or looser monetary policy. They all tend to reduce interest rates, and they all encourage more lending and more overall demand in the economy. In terms of our aggregate supply and demand model, they increase the amount of aggregate demand that's out there in the economy. On the flip side, what would steps be to reduce the growth in the money supply? Or at least to restrain the rate of growth in the money supply that might otherwise have happened? What would be involved with an expansionary or contractionary or a tight monetary policy? Well, it would be a higher discount rate to discourage banks from lending. It would be open market operations of selling bonds, so banks have more bonds and less money, or it could be a higher reserve requirement. All of these would tend to change the money supply in such a way that you would have tighter money supply, you would have higher interest rates, and there would be less lending and overall demand in the economy. In terms of our aggregate supply and demand model, all of these steps would reduce aggregate demand or limit the rise in aggregate demand. When you hear news reports about the Federal Reserve, you typically hear something like the Fed has increased or decreased interest rates. And at this point, it should be more clear on what is actually happening. The Fed doesn't have dictatorial powers where it just says, we want interest rates to rise, we want interest rates to fall. Instead, the Federal Reserve, the central bank, affects the supply of funds that banks are willing to lend. With expansionary policy, more banks are willing to lend. With an increased supply of funds, interest rates fall. If the Fed uses contractionary monetary policy, banks lend less. With a decreased supply of loanable funds, interest rates rise. More specifically, the Fed actually targets or aims at one specific interest rate, called the federal funds rate. The federal funds rate is the interest rate at which banks make short-term loans to other banks, which is the interest rate for those specific loans we were talking about before. As this interest rate goes up or down, the federal funds interest rate, other interest rates like the rate on your car loan or your home loan, more or less move up and down with that rate. Although monetary policy and having interest rates rise or fall is the main task of the central bank and the one that gets the most media attention, it's worth noting that the government faces a number of other important tasks to help money and credit function smoothly in the economy. Let me give you some of the other tasks that a central bank has. A central bank must ensure that enough currency and coins are circulating through the financial system to meet all the demands of the public. So, for example, each year, the Federal Reserve has the responsibility of increasing the amount of currency available in banks around the Christmas shopping season and then reducing that amount of currency again in January. Or do you remember the months before January 1st, 2000, when there was fear that because of the Y2K problem, there would be computer breakdowns all over the U.S. economy that might affect businesses like banks? Well, it turned out when Y2K hit that there were a number of minor computer mishaps that happened. For example, the U.S. government lost touch with a set of spy satellites for about 4 days. A number of airports experienced short-term glitches in the computers that run their air traffic control systems. There were 7 nuclear power plants that experienced problems with their computer systems, and about 4,000 small businesses around the country found their systems for processing credit cards didn't work. But before that all happened, the Federal Reserve announced that it was going to have $200 billion in currency on hand, just in case the financial system crashed and everything needed to run on cash for a little while. In the banking system, people's demand for currency did surge right around January 1st, 2000, probably out of fear that something might happen. But the increase in the demand for currency was only about $20 billion. It was far less than the Federal Reserve had on hand and was ready to hand out. By the end of January 2001, January 2000, that extra $20 billion in cash had been deposited back into the banking system. But, the Fed's job, part of its job, is to be ready for things like that to happen. Another task for the central bank or the Federal Reserve. The Federal Reserve is a bank for banks. And so it plays a central role in clearing checks, so that if you write a check on one bank, it can get deposited in another bank. When you write a check, say, to buy a pizza, the pizza restaurant deposits the check in its bank, but then the check needs to be returned to your bank. Actually, these days it's a digital image of the check that gets returned to your bank. And then payments need to be made from your bank over to the pizza company's bank. The Federal Reserve actually contracts out a substantial amount of the work of collecting and sorting and photographing and transmitting checks to different private firms. But the Fed does act as a bank for the banks. It transfers funds as needed between banks to reflect the flow of checks that happens. Another task for the Federal Reserve, and more generally for the financial regulatory system. Banks pay into a system of deposit insurance. Deposit insurance is insurance to assure that all your deposits are protected, at least up to $100,000, even if the bank goes broke. Now, this is not run directly by the Federal Reserve or by the central bank in the United States, although in some other countries, deposit insurance is run by central banks. In the United States, there's something called the Federal Deposit Insurance Corporation, the FDIC. Banks pay an insurance premium into the FDIC, and then if the bank goes broke, there's a fund to pay off the depositors. The insurance premium is based on a bank's level of deposits, but it's adjusted according to the riskiness of a bank's financial situation. In 2002, for example, a fairly safe bank might have paid about 3 cents in deposit insurance premiums for every $100 in bank deposits. A risky bank might have paid 27 cents for every $100 in bank deposits. Now, what exactly do I mean here by safe and risky banks? Well, bank examiners from the FDIC look at banks. They look at the value of their loans, how many of the loans are being paid off, what the conditions are of those loans, how much the bank owes, and in general, the overall bank's financial situation. And they rank whether the bank is in very good financial shape or not so good, and all the way down. So it's those rankings which determine whether or not a bank should pay a higher or a lower level on its deposit insurance. The FDIC provides deposit insurance for about 5,300 banks in the United States. Even if a bank goes broke and the executives of the bank lose their jobs and the bank vanishes, the government guarantees depositors will get their money up to $100,000, which is obviously enough for almost all individuals, not for some businesses. But this deposit insurance is not just an empty promise. You remember when the savings and loan institutions went broke in the late 1980s and early 1990s? The federal government ended up paying out $150 billion because there wasn't enough money stored up in the deposit insurance fund. Another task for central banks. The Federal Reserve, along with the U.S. Department of the Treasury, plays a key role in auditing the banks to make sure they have sufficient financial assets and they're not making overly risky loans. I mean, after all, part of the deal is if you're going to provide deposit insurance, you darn well also better guarantee that banks are being operated in a prudent manner. Within the U.S. Department of the Treasury, there's something called the Office of the Comptroller of the Currency. It has a national staff of bank examiners who conduct on-site reviews of the 2,600 or so largest national banks. There's another office called the Office of Thrift Supervision that monitors and regulates about 950 savings and loan institutions. And there's another organization called the National Credit Union Administration that looks at credit unions, which are non-profit banks that are owned and technically run by their members. The Federal Reserve also has some responsibility for supervising financial institutions in a direct way. Right now, there are a lot of firms that own banks, and they also own other financial companies like insurance firms or brokerage companies. Those are called bank holding companies, and the Federal Reserve oversees bank holding companies somewhat directly. So for those of you who like alphabet soup, here's how it all comes together. There's something called the Federal Financial Institutions Examination Council, the FFIEC. It includes the Federal Deposit Insurance Corporation, the FDIC. It includes the National Credit Union Administration, the NCUA, the Office of the Comptroller of the Currency, the OCC, the Office of Thrift Supervision, the OTS, and the Federal Reserve, which we'll just call the Fed. Basically, the FFIEC, the overall umbrella organization, tries to make sure that all of these bank regulators all communicate with each other and use similar standards when they're evaluating the riskiness of the banks. A central bank like the Fed also has a role as what's called a lender of last resort. That is, when a financial system is actually or potentially endangered by a major financial crash, the central bank provides short-term loans so the financial system doesn't explode or implode. Financial panics can sort of build on themselves and create a kind of an avalanche of panic. This idea has entered the plot of a lot of different well-known movies. In Mary Poppins, for example, you may remember a scene where the little boy Michael wants his tuppence back. And when someone overhears that the bank director, who's played by Dick Van Dyke, won't give back his money, then everyone rushes to the bank and tries to get their money out, and the bank shuts down. Or another movie, in It's a Wonderful Life, the bank manager who's played by Jimmy Stewart faces a mob of worried bank depositors who all want to withdraw their money. And he has to reach into his pockets and pull out the money that was supposed to pay for his honeymoon and say, will you just take some of it? Will you just take some of it? Those are examples of what are called bank runs. People ran to the bank so as not to lose their money. That was before the time of deposit insurance. Mary Poppins is set in 1910. It's a Wonderful Life is set during the Depression. So we don't have these bank runs anymore. People know their money is safe. But there's still a chance, for various reasons, the financial system could go into a kind of gridlock. During the panic of the stock market crash in October 1987, when the value of U.S. stocks fell by 25% in a single day, no one quite knew where they stood. What if you were a financial institution that had a relationship with another institution that held a lot of stock? You knew that other institution had absorbed a lot of losses. Was that institution broke? Were you broke? If you were broke, then were all the firms dealing with broke? Where were the losses? How were they distributed? No one quite knew. So on that day, the Federal Reserve was out there saying, anyone who needs money, we will loan short-term at the discount rate of interest, and we will loan an almost unlimited amount, just so the system can keep working, doesn't grind to a halt, and we can sort everything out next week or the week after when things become more clear. In a situation of extreme financial distress, the fear that other institutions might be bankrupt can lead to a situation where the entire financial system enters a kind of gridlock and almost shuts down. And in that situation, the job of a central bank like the Federal Reserve is to go out there and make lots and lots of short-term emergency loans so the system can keep functioning, not go into gridlock, and then we can just sort it all out later. All large economies have a central bank, and most small economies too. Along with the Federal Reserve, some of the other better-known ones are the European Central Bank, which replaced many national banks across Europe when the European Union adopted the euro. The Bank of England is another big one, since the British pound is not in the euro. The Bank of Japan, Bank of China. All of these central banks have both the power and the responsibility to conduct monetary policy and to participate in the soundness and safety of the banking system. In the next lecture, we'll focus on the actual policy choices in the conduct of monetary policy, which can be a source of considerable controversy.